Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This is for April 28th on Friday, getting ready for the open on May 1st. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Got two reports for you today, the S&P 500 Condor Butterfly Timing Report and the Directional Likelihood Report as well for those of you that are more statistically oriented. Let's, before we get going, please, if you want an e-trading book, we got this one for free from Jim Graham and myself, Simple Steps to Options Trading Success. Just click on the link. Also click on the button to subscribe and you'll get then noticed whenever we post a new recording. Here is the current market condition. Price had a downswing on Thursday. Friday was an outside bar. We're above the 50-day moving average. We're between 55 and 99, kind of in the overbought territory on the stochastic, but it's turning downward. This is a very unique market condition that's only occurred about 40 times in the past. Let's go to the first report, the Condor Butterfly Timing Report. Since January 2000, there have been over 4,300 daily closes of the SPX. Now of these, 64.9, about 65%, have been favorable for selling premium, where the actual ensuing 21 bar movement was less than the SIBO skew adjusted implied movement. Okay, now also during that time, the current condition I just showed you has occurred about 40 times. Of these occurrences, 75% of the bars have been similarly favorable for premium selling. This implies an option premium selling edge of about 10.1%, 75 minus 64.9. So folks, Condor Butterfly traders, you advanced traders, listen up. Statistically, it's slightly more likely, it is more likely than usual that Friday's bar will end up being favorable for market neutral option premium selling. Okay, that's the Condor Butterfly Timing Report. For those of you brand new, stick around. I'm going to get into the methodology behind all this. I do this every time, but for those of you veterans, that's the report for today. Let's look at the Market Likelihood Report. We can see here, and again, you new folks, stick around. I'm going to go through all this. Those of you that have been through this already, you know what we're looking at. We've got 6 distribution bands. What we're seeing here is of those 41 occurrences, all 6 bands were struck less often. So this is a picture of lower market volatility going on. So it's more likely than usual that we'll experience lower market volatility both to the upside and the downside. Now, if price exceeds Thursday's high, again, all 6 bands getting struck less often. If price strikes and goes below Friday's low, then there's a likelihood that we'll experience more than usual market volatility that you can see here. The bands are getting struck a bit more often, some of them not that much more, but a bit more. So that's the likelihood report, and the VIX bands just simply confirm that same conclusion. Okay, that's the report. Now, for those, if you want to stick around, here's the methodology behind these. This is good stuff. Here we go. The Condor Butterfly Timing Report. Many of you might put on butterflies and condors when you find that the market's chopping around, and here's an example where it was doing that at the end of December 15. But really, if you really take a look and run it through our algorithms, we would have discovered that there was a negative edge at the time, meaning that there was a higher than usual likelihood that the market would be more volatile than what was implied at the time by the option prices, and it turned out to be predictive. Okay, so that can be predictive if you run these reports that we like to do. Here's the question on the table on this, for Condor Butterfly folks. Is our current market condition that you see right there, is this a good one for selling premium neutrally through butters and condors? Real simple question. Using technical analysis, we should be able to answer it. Okay, so here's what we do. We first understand actual volatility. Then we have to understand implied volatility, and then we compare the two in retrospect, in hindsight, and then label the bars either having been favorable or unfavorable. Here's just an example. From any close, we can go forward in time 21 bars and ask ourselves, how far did the market move either up or down? What's the maximum amount that it moved? In this case, the maximum amount was 50 points to the downside. That was 2.4%. Okay? And we graph that in an indicator. At the time, what move was being implied by the option prices? We know what happened in the future, but at that time, what was being implied? When we look at the VIX, we adjust for the skew, it was implying a move of 4.4%. That's higher than what actually took place. So we label that bar favorable. It would have been good to sell premium there at that implied volatility rate because the ensuing actual move was much lower. See that? So we go back in time, we label every bar favorable or unfavorable just to get a benchmark. And in this case, we're going to look at the percentage of bars that were favorable. Then we're going to isolate only those bars that meet our current market condition parameters, roughly 40 of them, going back to Jan of 2000. If we discover a big difference, well, that could represent a good edge. So when we go back in time, we look at those 4,322 occurrences or closes, 64.9, about 65%, ended up being favorable. All right. Now then, we then isolate those that match our current market condition, which is very unique. Hasn't happened that often. And when we have found them, when we add it all up, roughly 3/4, 30 of those 40 or so, ended up being favorable for selling premium neutrally. Blue bars, 25% of those ended up being red bars. So that means we do have a quantified edge here of about 10%. 75% of those that match our condition, current one, were favorable versus the benchmark or the historical level of 65%. So there you have it. That's the methodology we use. Before we get to the other one, folks at Discover Options, we have a great curriculum. Check out our website, surf around the curriculum, give us a phone call. We'd love to walk you through what we can do for you. We have a great set of mentors that cut their edge on the trading floor. They've managed money. Some of them are managing money now. And we would love to help you get to a very advanced level of options trading. So give us a good look here if you're in the market at all for options education. Let's go to our market likelihood report. The question on the table here is, how often has our current market condition occurred? And what did the market do in terms of direction and volatility? So let's just take our current condition, and I outline the definition for it here. We're going to go back in time and see what happened. Now, how do we measure when we say what happened? How do we measure what happened? I'm using my fingers in little quotations. Well, we do this by understanding distribution of price. First, we're going to look at what the benchmark historical distribution of price is for the market going back to Jan of 2000. Then we're going to look at the distribution of price after our little market condition developed. Okay, then we look at the two and we compare them to see if there's any big difference. How do we measure historical distribution of price? I like to use, and I just invented these, I'm calling them distribution bands. 1 standard deviation volatility bands placed from each bar's closing price. 5, 10, and 15 days out. They're set 1 standard deviation using a 20-day historical volatility number, and these are distributed log normally. Here's an example. From this close, I'm showing a 10-day band up above it. Steve, come on. You know, this mouse is just something. All right, a 10-day band here, 10-day band here. Question is did price hit the upper, the lower, or wobble in the middle? And in this case, it definitely went up and hit the upper band. Then we have another close over here. Okay, did price go up and hit the upper band, the lower band, or wobble around and do nothing? In this case, you could see it tried to hit that lower band and failed to. So for that particular close, it hit neither. So for every close then, we record whether price struck the upper or the lower 5, 10, or 15-day bands. And we keep these statistically recorded just like this. So that out of 4,322 closes, we know that price struck the upper 5, 10, and 15-day bands 23 to 30% of the time about. It struck the lower 5, 10, and 15-day bands roughly 29 to 32% of the time. And that's the historical distribution. Now we have to understand the distribution after our condition developed. So here's our market condition. It hasn't occurred that often, but we're going to go back and look, and we're going to look at all 40 of those closes. Of those 40, if price went above the high of the previous day, we're going to look at the distribution in that particular instance, and we're going to look at the distribution in the instances where it penetrated the previous day's low. I think that would really help us going into Monday's open. So as of the close, we had 41 closes here. Okay, we could see that those bands got struck less often, pretty much less often. See that? Less often. So this is a picture of lower market volatility. Okay, if in the 12 incidences where price went above the previous day's high, above Friday's high in this case, okay, price again struck the bands less often by quite a bit. Now it's not too many, only 12, granted. But in the case where price exceeded the previous day's low, where Friday's low was exceeded, then the market gets a little bit more rambunctious in that case. And in fact, all 6 of the bands get struck more often out of those 23 occurrences. Okay, so this should help you on Monday morning, knowing that there's a different distribution of price historically if price goes above Friday's high versus if it exceeds Friday's low. And hopefully that can give you some perspective on what the future would more likely hold. I also like to recast these bands using a skew adjusted VIX that you see here, and this is pretty much confirming our findings, except you can see on the upper band side in the case where price exceeds the low, those upper bands, we're seeing that they get struck a bit less often in those cases. A little bit different than what we showed for the other statistical. Okay, a big difference actually. Okay, folks, thanks for joining us. We'll see you next week. Good luck trading this week. Take care. Bye-bye.